And so given that we don't want to remain uber aggressive while we are retired, then what do we do? What can we do? What are good choices? What are good ideas as to how we should be putting our money away for later? Well, there are a few choices just right off the top that give us income, right, that we can use as retirement investments. The first of which being dividend paying stocks, right? Dividend paying stocks are a great source of both income and what we call capital appreciation, meaning the price of the shares going up over time. But they're a great source of income because they pay you dividends systematically, right? Either on a quarterly basis or on maybe a monthly basis or maybe semi-annually. But they can pay on different time intervals. And in paying us dividends, that's going to allow us to have some type of retirement income. But they are still stocks, they are still companies, right? And these companies hopefully grow and the stock price goes up over time. And if the stock price is going up and you're receiving dividends, you're receiving income, and the value of your nest egg is going up, that is a win-win if you can purchase good dividend-paying stocks for the long term and find what they call dividend yields that will sustain you as far as income goes. Because dividend yield is just saying the amount of dividend you will receive over the course of a year over the current price at which you purchased whatever dividend paying stock or dividend paying mutual fund that it may have been. So let's say that you have a stock at $100 with a 3% dividend yield. That means you're going to receive $3 for every one share at $100 that you own. So that's a 3% dividend yield. And so receiving this type of yield, right, would tell us that we can automatically get 3% in return off of these investments without the price doing anything, which is beneficial. And so dividend paying stocks can be extremely beneficial, and they can provide upside if they grow into the future. One of the things that you may want to look at are the dividend aristocrats, which are the companies that have increased their dividends, grown their dividends every year for the last 25 years. So the dividends are stable, and many of them still have good growth prospects into the future. So that's something to keep your eye on first and foremost. Another thing that can create income in retirement for FIRE retirees are bonds, right? Now, you still want to be having some capital appreciation, especially with a longer time horizon in retirement. And bonds are not going to provide as much capital appreciation or increase in price over time, especially if you're holding bonds to maturity. They're just not going to provide a lot of capital appreciation over time, but they will provide you with interest payments. And these interest payments can allow you to receive more income in retirement. Now, this income is going to be fixed, right? Whereas dividends can be dynamic. They can change, they can increase over time as inflation increases, as the cost of living increases. Well, interest payments are fixed. Okay, so this is a source of income, but the interest payments are fixed and the capital appreciation is not fantastic. So bonds can be a good portion of your portfolio for good stability and guaranteed fixed income, but we don't want to rely on them for everything because of the fact that inflation will eat away at the value of that income over time. And so that is another option as far as income being produced by our investments. But another option that kind of plays off of the option of having a bond in your portfolio or bonds in your portfolio are municipal bonds. And municipal bonds are still bonds in nature, and they have some of the same issues that normal bonds have: lack of capital appreciation. They have the issue of a fixed income. So they're susceptible to inflation risk. But municipal bonds, you do not have to pay federal income tax on the interest earned. So they provide you something in return. They provide you some type of benefit, given the fact that that bond is going to be susceptible to inflation over time, and you're not going to get a lot of capital appreciation. Well, you'll get to minimize your taxes, which is just as big a part of all this as anything. The more you can minimize your taxes, the better, because having after-tax investments is huge. That's why we want to make sure we are still putting money into the Roth IRAs and traditional IRAs for our future, and 401ks if we're getting matches when we are not retired yet, right, but want to enter into retirement pretty soon. We still need to be doing those types of things, but we have to have our foot on the gas when it comes to taxable investing and putting money away there, because we can still minimize our taxes within taxable investments, whether it be municipal bonds where you don't have to pay federal income tax on the interest, or anything else you purchase within there that you can pay the long-term capital gains tax on and not the short-term taxes. And so that is something that must be kept in mind to maximize your nest egg and maximize the retirement income that you can take off of your nest egg. Now, our portfolios should still have some growth opportunities within them, right? I talked about some dividend-paying stocks that have growth opportunities. I talked about how bonds may not have the same type of growth opportunities that stocks have. I mean, they definitely won't as far as price, but there's also the idea, and we can have income off of rental real estate, okay? And rental real estate is a fantastic idea as far as the appreciation of our capital, the appreciation of price over time, and the rents that you will receive off of that rental real estate that will allow you to sustain yourself in retirement. Because if people want to stay living in whatever you own, they have to pay the rents, right? Therefore, it provides a stable cash flow, which in a similar way to dividends, you can increase rents over time systematically, therefore being able to keep up with inflation, and the value of whatever property you own hopefully goes up over time in the same way a dividend stock would go up in value over time. But the rents that you receive can be far, far higher as a percentage of your assets than a dividend paying stock on average. And so rental real estate is a huge thing. It is a huge opportunity for you in your retirement dreams, if that is something you're interested in, if you want to work towards managing some rental properties. I think it's a great idea. But let us not go into debt to do so, especially if you're retiring early. Because remember, debt is a strain on your cash flow, and we need all of the cash flow that we can have if we are going to be retiring early. So we want to make sure that we have built up enough in assets in order to pay in cash for whatever rental property we want, and then take the rents off of that and reinvest them maybe into a mutual fund or an ETF or something. And then when they've built up enough, if you want another one, go buy another rental property and continue that cycle of using the rents to reinvest until you get to retirement. And then maybe you can still purchase some, but you're going to be using those rents in order for you to live. But do not use those rents in order for you to live before retirement, because we want to keep our money compounding. And when you're taking those rents out and using them to live, then you're no longer compounding your money. You're just sustaining some principal value of whatever the property is worth, and just using the rents on whatever you want to use them on. So we need to make sure that our money is compounding before retirement, but then when we're in retirement, they can pay us really good income that can be sustainable into the future. Now, these different types of things that can create income for us may not be enough, right? It may not be enough income in order to sustain us into the long term. And that's okay, right? It is okay if those types of things cannot provide us enough income. But that means that other things have to provide us income, okay? That means that the other parts of our portfolio are going to have to create enough capital appreciation in order to get us the income we need. So apart from just dividend paying stocks, you can still have portions of your portfolio that are growth portions, right? Not just income portions of your portfolio. You can still have growth portions to where you're investing in things like the S&P 500, large cap mutual funds, small cap mutual funds, whatever, even though these should now be a smaller portion of your portfolio than they were when you were pre-retirement, right? But now you can be holding these types of things and you can hold them and get some growth out of them, and then just sell whatever you own within them in order to realize those gains and take that growth off in the way of income, quote unquote, to yourself, right? And so just because you're not creating true income doesn't mean that the capital appreciation of your investments is not going to provide income for you. So I think that's important to keep in mind. But these are just some basic asset classes through which you can get income for retirement. And if you're going to retire early, you need to be able to sustain that income over the long term. And so make sure that you do your due diligence beforehand.